anyone that's familiar with real estate and has a tax liability should definitely look further into. It can significantly offset some of those potential gains. But again, it's a conversation you need to have with your CPA and understand how much of that depreciation you could take as an investor in a deal.
If you're not conscious about your investment strategy, you won't end up where you want to be, not financially or as a human. On this show, we interview highly successful investors and share how they overcame limitations to become unstoppable forces of success. If you're ready to learn what it is to be a conscious investor so you can end up where you want, keep listening.
Conscious investor, welcome back. If you are watching over on YouTube, you have a special treat because you have a little window into the Ollie family front yard, actually. Summer in North Idaho. So I'm recording this outside in summer, which makes this no longer evergreen content, which is a poo-poo, right? But I really wanted to have a clean recording because my friend Dallon is joining me this morning. And he is just so phenomenal. He's such a fun person. He's so smart, so articulate. I didn't want to have any of those internet lags or anything like that. I want you right now to just hit pause, head over to the Millionaire Mind. That's Dallon's podcast. It's so much fun. It's so insightful. And I am absolutely confident that you're going to enjoy listening to him and you're going to enjoy the guests that he has. And you're just going to gain so much from adding that podcast to your repertoire. And as always, remember, conscious investor, when you leave a rating and review on any podcast, you're really giving them a shout out and you are helping other people find that podcast. So go ahead, make sure when you go head over to the Millionaire Mind that you leave that rating and review. And if you haven't already done so for the Conscious Investor podcast, why not? Just take a moment and drop that down at the very bottom. All right. I don't even want to hesitate a moment longer because Dallon and I, we're both talkers and we're going to have a great conversation for you. Now, this conversation is definitely for you, passive investor, conscious investor. You are looking for that next investment opportunity. You're trying to crack the code. You love your job. And we are going to have a conversation that is going to empower you on making that next decision to add to and build your investment portfolio on the passive side. You like your job. You like your time with your family. You don't want to spend your time trying to learn a bunch of nuances you really don't need to learn. So, Dallon, welcome to the Conscious Investor.
Julie, so excited to be here. And thanks for that awesome intro. And shout out to our podcast. And for those listening and our avid listeners to Julie and her podcast, we actually had her on a couple of weeks ago. And so if you want to get an insight to more of the background of Julie, what she does, definitely keep an eye out for that episode because we'll be releasing it here shortly.
And definitely remember, Conscious Investor, I've said this before, but pod stalking is completely acceptable. Type in the name of whoever you want to get to know better and look for podcasts. So you might put in Dallon Schultz podcast and a whole bunch of podcasts that he's been on, then the podcast he hosts, that's going to be there. And when you listen to everybody interact with different hosts, you're going to find a different nuance about them. You don't want to hear the same cookie cutter story. That does happen occasionally. But more often than not, you're going to hear different facets of their life, their journey, and their perspective. So pod stock away. Dallon, you and I were talking before we jumped in the green room. We were talking about how are we going to serve the conscious investor? And I'm so excited to jump into this conversation. Before I totally give it away, are you excited about jumping into this conversation?
Yeah, Julie, you and I, we connected at a conference a few weeks back, and I feel like we just hit it off because there's so much synergy and similarities between who we are as people and how we want to operate our businesses. So yeah, I'm excited to get into it. At the end of the day, you and I are here to serve the investor, the passive investor. So excited to see what comes up.
It is. And that's another reminder, conscious investor, to make sure that you are attending events, whatever kind of events those are, but just getting to know other people is such a powerful opportunity. And I am going to name that event was my friend Dustin Heiner's event, a friend of Dallon's as well, the Real Estate Wealth Builders Conference. You can already jump on board. It's going to be in St. Louis at the beginning of 2024. So I want to encourage you to jump ahead. It's a fantastic event. You will meet amazing people, whether you're passive or active, or you're just trying to figure out the difference between the two. Fantastic conference and conversations for you to participate in. Let's do this. Let's jump in because I've noticed I've been having a lot of conversations with investors, and it's interesting that a lot of investors are thinking that passive income is actually like, oh, I have a REIT. I'm invested in real estate. It's passive. I have REITs. And I hear other people compare what we do in the private equity space through investing capital into real estate assets. I hear a lot of people say, oh, well, my stocks are passive, my bonds are passive, my REITs are passive. So I was thinking it would be helpful to really explain to the conscious investor the difference between these are not passive incomes, let's just talk about this. Let me get your perspective.
So the difference between a REIT stock versus what we do in the fund syndication private equity space.
Yes.
So first and foremost, a lot of people don't even know about what you and I do, believe it or not. And like it's you and I are in the space every day. So we fall into the trap of everybody knows what we do. And that's really not the reality. And if you think about it, a lot of us went to school, we're groomed to get a degree, become employees, invest in your 401k. And that's very much the corporate planned route, if you will. And I know some people that have done very, very well there. But what we're seeing on our end, and maybe you could agree with this, Julie, is almost like this grand awakening of people like, wait, these corporations, these stocks, these 401ks, like they're not performing. And why am I just giving my money to these people that are supposed to be managing it, but yet I'm still experiencing negative returns in the stock market? And a lot of people are losing faith in that space. Now, and listen, I'm not talking to the people that are day trading and that know how to time the market and all that jazz there. And I'll be honest, that's not my area of specialty. That's why I do real estate. So I'm talking about the person that's just has an auto withdrawal from their account going into a Roth IRA, traditional. They're not even looking at it except maybe once a year. And I got to share a quick experience on this.
Definitely.
One of our partners at REV had been contributing to a Roth using a financial advisor, somebody that she trusted. And as we've been going down this path as a company, trying to help people get into self-directed IRAs, get them out of their retirement plans into a vehicle where they have more control that they can use to invest in things like crypto, like real estate, like gold and silver. She's like, hey, I've been investing for the past 6 years. I'm going to take a look at this. So she was doing, I think, $600 a month, just auto withdraw into this account for a little over 5 years. She should have, at minimum, right around 30,000, maybe a little bit more, right? She opened this up for the first time in a long time. She is averaging a negative 15% return.
Oh my gosh, that's painful.
So what she actually has in her account, I think, was like $16,000, $17,000.
Oh my gosh.
But she's contributed over 30,000. Now she's pissed off because this is somebody that she trusted. And guess what this person was doing every single month while she was experiencing a negative 15% return? Still
having a great time.
Still collecting their monthly management fee. Still collecting their 6% monthly management fee while her portfolio is just tanking. And that was a small case. Like, I know there's people that have way more than that invested in the stock market. And she was frustrated because she's like, I put my trust into this person and what the hell are they doing? What are they doing? And I think that's happening a lot more as of recent. And this is one of the challenges that you and I have as trusted operators, is that puts a bad taste in people's mouth. And so when we're trying to build relationships with them and show what we do and how it's a little bit different and how it can actually benefit them more, if somebody's already been burned financially, it's very, very hard for them to put trust in another person.
Yeah.
And I know for you and I, that's one of the main things we focus on, because at the end of the day, those that choose to partner with us, they are passive investors. So yes, they can choose what types of deals and opportunities that they invest in, but at the end of the day, they are trusting us to manage their capital effectively.
Oh, I have so many comments on this. So one, I think that is so indicative of many people. Conscious investor, I'm sorry, I'm just going to ask you to just take a moment and reflect. When was the last time you opened up that retirement statement from the brokerage account? When was the last time you looked at it candidly and looked at what the trends were, looked at what the returns are? And quite frankly, everyone should be compensated for the work they do. So I'm not suggesting this at all, that there's any foul play. But I would also look at, what is somebody else being compensated based off of your investment as they're managing that? Now, one of the elements I happen to love about, and this isn't like, I'm not trying to put us against each other, because, like those financial planners versus what we do in the private equity space. But I am trying to say it is really helpful to remember that those in the private equity space, with what you do at REV, I do at Three Keys Investments, there's zero compensation. If we don't perform, we're not getting any compensation. There is nothing for us. And so we're highly motivated to ensure that there is a strong business plan on the front end and to carry it out with full thunder so that everyone is winning.
I want to state too, like, this isn't all financial planners. This isn't all financial advisors. In any industry you go in, there's going to be bad apples, right? There's going to be people that are just trying to take the easy route and take advantage. We see this in the medical field, right? There's people, maybe some of us listening have had this experience where we're having a conversation with a doctor that we're trusting ourselves to receive medical advice from. And you sit there and you wonder, how did this person get through medical school? Right? Like, so this isn't to dog on financial advisors, financial planners, because very good ones will say, hey, Julie, I know you're diversified over here in the stocks and they're doing okay, but given your situation, given your taxes that you might have upcoming, you might want to consider a private investment or an alternative investment with a group like REV, like a group like Three Keys. Now, obviously, we can't give tax advice, Julie, because we're not CPAs or tax advisors, but it's a well-known fact that real estate is one of the most tax favorable vehicles for people looking to offset that. So definitely consult with your CPA or tax advisor. But at the end of the day, we want to work with financial advisors. We want to work with good ones, good partners. At the end of the day, we're all here to help each other grow and preserve our wealth. And our why at REV, like, that's our primary focus, is to help people grow and preserve their wealth, because everybody has an individual why. And what we found is that our why is that we want to give and we want to serve. And so the people that we attract into our company and partner with us, they too want to give and serve. And we simply just use apartments as that vehicle to grow and preserve their wealth so that they could give more freely and abundantly however they see fit.
I love that. And I think we have a shared spirit also, our companies, of really being able to provide that. Part of that serving conscious investor is, wow, I'm able to serve and support residents and the community through this investment. So we can go so much further with that. I want to give a shout out real fast. I'm not going to drop names specifically, but conscious investor, if you are looking for financial planners that are balanced in a perspective, they're out there. And I actually had one reach out to me. He went to a real estate meetup and we've connected and spoken since. And he said, very specifically, sure, he does a traditional stocks, bonds, and all the paper assets. And he also wants to serve his clients through real estate investments. And although he will not receive any compensation for it, he wants to truly serve his clients. So they are definitely out there, and he's not the only one that I'm aware of. But I'm always impressed when I meet financial planners who are going and taking the time to learn about alternative assets that can help and support their clients in powerful ways.
Yeah, and I think that's a great question to bring up if you're interviewing or looking into financial advisors or even operators such as ourselves. Find out what else are they knowledgeable of? What else are they involved? Especially a financial advisor. Like people like you and I, Julie, they come to us because they want specifically what we offer, right? But your financial advisor, they're looking at your overall financial health as an individual, as a company. So they should have experience. They should have connections in various areas around building and growing wealth. Because at the end of the day, that's why we trust people like that.
Yeah, it's a substantial reason why. One of the questions I have been asked by several conscious investors, and they happen to be white coat investors, meaning they're in the medical profession and they're placing capital into our investments. And one of the questions is like, what happens at the end of this investment? Sure, I'm going to get distributions along the way, but I'm looking at my tax liability at the end of this. Like, what does that look like? And now, conscious investor, remember, Dallon and I are not offering any type of tax advice or counsel or guidance. We're just going to have a casual conversation. Always talk to your CPA. And I'm saying that as a caveat, just in case. We're going to just share some experience that we've had, and always go to your trusted tax strategist and advisor. So they're getting that huge, we just exited a deal. There's a really sizable amount coming back their way, and they're concerned about, hey, this is going to affect my taxes.
So there's a well-known term out here related to taxes, and this isn't advice, it's just a fact. It's called depreciation. And depreciation is that magic word that anyone that's familiar with real estate and has a large tax liability should definitely look further into. It can significantly, depending on your situation, offset some of those potential gains. But again, it's a conversation you need to have with your CPA and understand how much of that depreciation you could take as an investor in a deal, because it's allocated differently. So your operators who you're looking to partner with should be able to disclose that and give you a roundabout number saying, hey, we're expecting that you, given this amount of investment, could potentially take about this much of depreciation. And what depreciation is, it's a loss. It's a paper loss the IRS allows. It's not a loophole. It's written into the tax code, and it allows you to take a paper loss for the wear and tear that property is going to be experiencing. And there's different things that you could depreciate in a different amount of times, and some you could take up front. You can accelerate, take it up front, but that changes at this point annually as far as your bonus depreciation. So definitely a conversation to have with your CPA, and even with your operator. They can help you understand a little bit more about what it is without giving that advice. But so that's a big one, right? A lot of people that are listening to this are probably familiar with 1031s. And on this note, this comes up quite a bit. So I think it would be important to touch on. Question we get a lot is, hey, Dallon, I got the single family home. I've owned it for a few years. There's a couple $100,000 equity. Can I sell that and 1031 it into one of your passive investment opportunities? And the question is yes and no. And I think this is important to touch on, because with a 1031 exchange, it's a like for like exchange. Mm-hmm. So if you personally own real estate interest and you sell that and you come into a deal with myself or with you, Julie, we're not selling real estate. We're selling interest in the company that buys the real estate. So it's not a like for like exchange. Now, the caveat to this, if you have we'll say an 8-unit apartment building you bought 10 years ago on your own, and now you've got $2 million in equity in that deal, and you want to 1031 it into an opportunity that you or I are presenting. So in that situation, what you would set up is what they call a tenant in common. So you're no longer buying interest in that company that's buying the real estate. You're coming in as a separate partner. So in that situation, you could 1031 into the deal, but most operators are going to need to see a significant amount of money. And I don't know what that is. It's going to be different for everyone, but let's assume it's a $10 million raise. You might need to come in with $500,000 before an operator is even open to considering a tenant in common. So definitely something to understand and be aware of. Now, with that being said, if you invest into a passive opportunity that you and I have, and that property comes up to sell, we could, and we have the option, as long as people are in agreement, that we could just 1031 that or roll it into another real estate property, because now your initial purchase was shares in the company. So now your 1031 is more shares in another company. So now that is like for like.
Yeah. And I think an interesting element here is also to understand, because conscious investor, I have this question come across my plate on a regular basis, like, oh, can I 1031? And there are going to be some pros and cons about 1031ing into an investment. One of the interesting elements, I'll speak specifically for Three Keys Investments, we generally won't entertain a 1031 under $1 million. The legal costs in and of themselves are exorbitant. They are substantial. And so you need to keep that in consideration. Now, one thing you could do is say some operators won't even, sponsor teams won't even entertain paying those legal fees. So you just come out of the gate and say, hey, can I bring, if you want to come in under that, can I bring $500,000 or $750,000, $750,000? I will cover all the legal expenses. That starts a different conversation. So I think that that's something to keep in mind. What do you think of this, Dallon? Is really working with your tax strategist to understand, is 1031ing this actually in my best interest, or should I just take the hit and pay the taxes now? More control over your liquidity if you're taking the tax and paying it now.
100%. And definitely a conversation to have with your CPA. And when I say CPA, I'm talking real estate centric CPA. Okay. Don't just go find somebody off that's going to cost $500 a month or a year, right, to do your tax return. Like invest in your CPA, because they will save you thousands of dollars. But to your point, yes, it may not make sense to do a 1031. Your CPA might say, hey, you know what, Dallon? It's actually probably better if you just pull this out, pay the capital gains tax, which is still less than ordinary income, right? So pay it, reinvest it. And with this strategy, you could potentially see that money grow tax-free moving forward. So that's where having a good tax advisor, a good CPA is critical, especially if you're looking to get involved in real estate. And with the 1031, you've got a time crunch. You've got to identify properties and you got to put that money to work. And if you don't find it, people feel rushed and they end up making purchases or paying more for a property that they want to have just because they didn't want to pay that little bit of tax, right? Yep. So it really comes down to a numbers game. Now, I'll say this, personal experience, the last 3 years legally have not paid any taxes just from all the real estate we've been buying and selling. Not once did I do a 1031. Because with our CPA, we were able to strategize and say, okay, you sold these properties at the start of the year. You need to purchase this amount of properties, take advantage of that depreciation, and that would offset any of the gains that you could potentially purchase. Now, it doesn't necessarily erase it, right? And I think that's something that people need to understand. Your taxes don't just go away, but you're managing it, you're deferring it, and you're strategizing to buy and sell and kick the can a little further down the road. So everybody's situation is a little bit different. And at the end of the day, get a extremely qualified real estate centric CPA that knows what the heck they're doing.
Hey, conscious investor. Often the well-intentioned hardwiring of our past prevents us from moving forward at full capacity. We doubt ourselves. We remind ourselves of who we were told we were instead of discovering who we were created to be. We lack courage to move into the life we're meant to lead, and often, instead of stepping into our full potential, many find themselves living a masked life, concerned with other people's expectations and opinions of their lives. Conscious performance coaching clients discover their potential is far more than they anticipated. Through conscious performance coaching, you will connect with your potential, gain lasting momentum, collapse your timelines, and, well, hey, every day feels like play. Stop playing small and step into your full potential. Join the ranks of those who have stepped into their dreams, launched successful businesses, and become unstoppable forces of success. Click the link in the show notes and apply for a free coaching session today.
This is absolutely key. Steve and I have gone through so many different CPAs because a CPA, honestly, generally speaking, is simply reporting. They're just writing up a very nice report at the end of the year and filing it for you. A CPA that is elite, next level, I would consider a tax strategist. Those are not actually synonymous. You can actually be a tax strategist without being a CPA. However, they understand the codes and they understand how to utilize and maximize the tax code to benefit you. I will say, you've heard me say before, conscious investor, deferring does not delete. So we can defer something, but there is going to be a recapture. And so you want to be planning for that recapture and figuring out what is our plan. And that's why having that plan in place from the beginning, always planning with the exit in mind. What does this look like at the end?
And you don't start planning in October or November when you're going to start filing at the start of the year, right? And maybe a couple meetings with your CPA or tax strategist periodically throughout the year. Now, it's very likely they're not going to go out of their way to schedule that meeting with you because they don't know what your needs are necessarily or what your plan is. So definitely take it into your own hands and say, hey, Mr. and Mrs. CPA tax strategist, we just exited this property. It's January 15th. We've got a whole year ahead of us. I want to sit down and strategize to see how we can offset or limit my tax liability as much as we can for this year. Like, take it into your own hands. You have to.
Definitely. And I'm one that as we have things even on the horizon, we will simply schedule a time or I'll send a text message and I'll be like, hey, I think this might be taking place with this deal. Maybe it's something. I know recently it was one of our passive investments was shifting and they were trying to decide if they were going to fully go full cycle and exit or if they're going to refi. And I was like, alert, alert. This is a liability that might be coming our way. Like, let's be on alert. Really key.
Absolutely.
Yeah. Well, Dallon, in the interest of professionals and serving and supporting busy professionals, like Conscious Investor, I know you love your job. I know over at REV, their investors love their jobs, their occupations. Going, like some people, it's not a job. It's not just going in, walking into an office and feeling unsatisfied at the end of the day. A lot of you love what you do and you see the impact of what you're doing. What are some of let's just speak to those professionals who love what they're doing, who are satisfied with their work, who are well compensated. Let's just talk about some of the benefits of our investment strategy.
So maybe this is a broad generalization, but I like to think that all of us, even you and I, Julie, want to build a life around passive income. Even though you and I are in the trenches, head down, providing these opportunities, not only for ourselves, but for other people, that it kind of organically happens because they see what we're doing and they're like, hey, I want to be a part of that.
Right.
I believe most of us want to create and design this life around passive income because there are things we want to do in this life. And that's different for everyone, right? Some people might want to travel. Some people might want to learn how to sail. Some people might want to learn how to fly a plane. People might want to spend more time with their family, with their kids. Maybe they have some parents that are coming up close to age of passing and they want to get out and spend more time with them. What I have found is that the people that choose to work with us, and I'm sure work with you, that are looking for this passive income, they want time. They want time and they want flexibility. And the way to do that is to get your money working for you. Your money is going to work 24/7. When you clock out at 5 o'clock at night and you're dinner and you're sleeping, if you have the right investments, that money is going to be working 24/7, 365 days a year. So I think understanding that for most of us, I like to think are coming from is that we want that passive income. Now, to those people that absolutely love what they do, this is one of the traps that I've seen quite often. People like the term of passive income. It's a buzzword. It's a trigger word, right? And so people typically associate passive income with real estate. So you'll have these busy professionals go out and say, hey, I'm going to go buy an Airbnb, or I'm going to buy a single family rental for that passive income. And what they often find very, very quickly is that there's absolutely nothing passive about it. Like, sure, you have a tenant in there paying rent, but what people fail to recognize is the time that it takes to manage that unit, cover repairs and maintenance, manage when you have turnover, people moving in and out. It's very, very active. And when people are getting started in the real estate space, they don't necessarily have the cash flow or the money to pay somebody else to do it, to manage it for them. Now, here's the thing with property management too. Nobody is going to take care of that property as good as you will. Nobody. And that's where a lot of these people get trapped. They start buying single family homes. They start buying small single family rental units, and they get sucked into this property management role. And now they don't have time. And now they're still working their other job, doing very well at it. But now they're just running around like chickens with their head cut off because they bought into this whole new business that they assumed and thought was going to be passive. I don't know why. I don't have an answer to this. Maybe I will in the near future. People will come into real estate thinking like, oh yeah, if they could do it, I could do it. Anyone could do it, right?
Definitely.
And yes, you can do it, but it doesn't mean that you should do it. It's the same reason why I'm not going to, I know this is kind of an extreme example, but maybe not. Like, hear me out here, right? A few years ago, I shattered both my elbows mountain biking. 8 hours of surgery, $35,000 later, they puzzle pieced my elbows back together with a bunch of metal. Okay. Not for 1 second while I was laying in that bed was I like, yeah, I could do this. I could be a surgeon. Why am I paying this guy? Like, I could do this. That didn't even cross my mind. Like, and part of the reason is I didn't want to. Like, if I was passionate about that, if I wanted to be an orthopedic surgeon and be very well known for what I do and fixing people, I could. I do believe that, right? Just as I believe other people could do real estate successfully. It doesn't mean that you should. And I think recognizing that and understanding it is key for passive investors to really start becoming passive investors and to effectively growing and preserving their wealth. Because at the end of the day, you're going to connect with an operator. You're going to connect with someone like myself, like Julie. And once you understand what we do and how we do it, you're going to say, hey, Julie does this as good, if not better, than I would do it if I was as passionate about it as she is. But I'm not. I love growing this medical practice over here. I love my chiropractic business. I love my dental office, right? And I do a hell of a job at it. But how passionate I am over here, I see that that's how Julie is over there. And since I understand how she invests into these deals, I'm comfortable partnering with her on these deals. And that's truly what it is. It's a partnership. When passive investors come in, it's not a loan. They are buying equity in the company. So we literally become partners for the next few years. So as you're looking to get involved in investments, you've got to make sure that the alignment and the investment strategy of that operator and that property is aligned with your goals. And I think a lot of people don't even know what those goals are. And that's where you and I, Julie, will start talking to them and start trying to better understand why they're even considering a passive investment and what do they consider a passive investment. And then from there, we could determine if it's a good fit or not. And sometimes it's not. Probably a lot more often, it's not a good fit than not. And that's okay. But you've got to have these conversations because we grow up in a society where you're not having them. You go through school, you graduate, you go to college, and all of a sudden it's like, hey, figure it out.
There's so many touch points here along the way of everything you're saying. I'm like, oh no, I didn't want to interrupt. I didn't want to interject because you're just like, truth.
I got on a little bit of a roll there. I apologize.
No apologies necessary at all. And I loved it. And really, I love what you're pointing out because, I mean, case in point right now, I mean, like I have some investors right now that are transitioning. They thought, yeah, let's just have that small single family portfolio on the side. And it has been a thorn in their side. They're smart, they're capable, they're very elite professionals. So there's no reason why they couldn't. I mean, like they're successful at it. It's just taking time and attention that they don't want to expend. It isn't that like, oh, I'm just collecting some mailbox money, because they are self-managing. And so I'm like, I hear this more often than not. And so a lot of times we know that, wow, I have a strong education. I am a high-performing professional. So of course I can go and I can invest in real estate and I can have that Airbnb, that short-term rental, or I can have the single family or duplex or something. But we're giving ourselves another job. And I think that's like so important. Now, I love what I do. And I got to share this. You might get a kick out of this. We had some friends over for dinner recently. And one of my friends asked, like, so what are you looking for with real estate? Like, what's your deal with your company? And I said, basically, he's looking for the numbers. Like, what's your exit number? When are you going to actually just like ditch real estate? And I told him, like, this is about the people. This is about using all the knowledge, skills, and expertise I've had, like, created over years to support people. I said, I don't have an exit number. I don't have once I make this much money, it's like, okay, I can wind things down. I'm like, no, this is like, I'm just as happy and excited about this as when I began years ago.
It's not about the money. It's about, I mean, obviously we're in the business to grow and preserve wealth and to make money for our investors, but there's so much more to it. And what we're energized is the impact and the journey that we're on and bringing people along with us. And that's why we get so excited about it. And people will, I'm sure you've experienced this, Julie. There's people I haven't talked to in over 10 years that are reaching out and saying, hey, I see what you're doing. I'm interested. Tell me more. And it's been a really unique way and cool way to rekindle some friendships and relationships.
Yeah, it's exciting and it's powerful. And knowing the impact that this has on people's lives. And to take this full circle as we wrap up, going back to when's the last time you looked at that 401k statement, that Roth statement, that whatever brokerage account statement that you have, we're coming at this from a different vantage point that's so unique. And so like we get to be crusaders or champions for people, because as my company transitions into on the horizon, we're investing in assisted living facilities. That's what our horizon is like. Yes, we are always dedicated to multifamily, but we are literally on mission for assisted living facilities. Our next repurchases, that's what we're like, conscious investor. We're always thinking ahead. What are the next purchases looking like? And when you start looking at the exorbitant costs of assisted living, and it's not exorbitant, I mean, when you're thinking about it, but I keep telling my kids, my husband, hey, here's what this is going to cost. We're going to be paying $5,000 a month, but what if only mom or dad has to be there? Then you have a house and you have this. When you start actually looking at what it looks like those later years in life, and as we're telling our kids, you're like, hey, we want you to be free. So not only are we looking for financial freedom for our family and for our investors, but now we're thinking, what about our grandkids? What about our kids when they're adults raising kids? How can we really ensure that there's not a burden placed on them, or that they don't feel a burden placed on them? And so this is such an important conversation as you looking, conscious investor, to your futures. Is the growth of your brokerage account going to support? And again, I believe in a well-balanced portfolio. So those brokerage accounts are important to your investment profile and everything, but is it going to be enough to create the life you want and the life you want to leave behind for your kids who are going to be adults and your grandkids and such?
I don't know too many people that have retired comfortably and with what or more than what they were expecting with just a 401k. I haven't met them. If you have, I'd love to meet them and figure out how they did it. At the end of the day, like, your financial future, your financial well-being is your responsibility. 100%. Even if you decide to partner with somebody like myself or Julie, your financial future is 100% your responsibility. Now, there's people like financial advisors, people like Julie and myself that are there to help you and coach you and assist. But at the end of the day, it's up to you to make sure you and your family are in that financial position at some point. And it's just taking ownership. It's taking ownership of your financial well-being. And listen, you are financially exactly where you deserve to be today based on the decisions you've made up to this point. That is on 100% on you. Don't blame it on the stock market. Don't blame it on a bad partner. Don't blame it on anything else that could have gone wrong. Like, you are where you deserve to be financially because of the decisions you've made up to this point. And if you don't like it, change it, explore. I mean, we have so much information at our fingertips now. There's podcasts galore. There's books galore. Find something that resonates with you and that sits right. And then find somebody that can help you accomplish that. And you'll be amazed at what you could do over the next 3 to 5 years if you make that decision today, especially with real estate. I'm telling you right now, do not wait to buy real estate. Buy real estate and wait, and stop telling yourself, I'll get into real estate when. I'll get into real estate when. We've all been there.
Okay. I was thinking about that on my run this morning. I was literally thinking about how many times you and I both know people that have a lot of capital sitting in accounts. They're just sitting in accounts accruing a nominal amount of interest. The thinking behind it is, I'm waiting for the fall. I'm waiting for the fallout. I'm going to buy up everything while there's blood in the streets. I'm going to go in there and buy at rock bottom prices. And that thinking, I'm just thinking, I used to think along those lines. Now my thinking has shifted because we sold something thinking we were timing the market right. And guess what? The market continued to appreciate. We did time it well, but it would have been so much better if we would have kept it. Wouldn't have been better because I wouldn't be where I am now, because that capital went into passive investments and things like that, right? Like, it definitely served us well. However, conscious investor, investing along the way in every market cycle always just knowing, is this a sound investment? Is there a great business plan and strategy here? Just being consistent and getting started in investing is going to be powerful for your life.
One thing I love about multifamily too, and I know this is why you got involved with it, Julie, is that if the market shifts, you adjust your underwriting, right? Maybe before you're projecting a 5 or 6% rent growth because it was a booming market. Now you're at 0% or maybe 1%. So good investors are buying in up and down markets. And with multifamily, you have so much more control of how to project that pro forma, and you can adjust the numbers more conservatively depending on what the market is doing. And you could just go along with it, right? You ride the waves, you go along with it. So as a passive investor, it's important to understand, if you're looking into a deal, what are your operators doing to keep up with interest rates? What are they doing to understand that market, that growth? What's happening more on a micro level, right? We all know the major cities that are blowing up. Phoenix is one of them. That's where I live. There's areas in Phoenix I want to invest in, right? So there's a lot that goes into it. And what a lot of people find out, I'm referring to ones that are buying that single family home, maybe 2 or 3, maybe an Airbnb. It becomes very heavy management. And then they meet somebody like you and I, and they're like, wait, you're saying I could potentially get that return, which is often higher than what they've been getting on their own, without doing any of the work. And we're like, yeah, that's exactly what we're saying. And that is a pivotal moment when they said, why did I just spend that last 2 or 3 years maybe getting 6-7% on my money, but spending so much more time in? And since you and I, Julie, go for much larger properties, we're able to capitalize on that economies of scale. So the investors, even though they're going to invest the same amount, maybe it's 100,000, maybe it's 150,000 that they would have done in a single family home, they're now leveraging and experiencing the benefits of owning institutional sized assets. And since there's a lot more units, a lot more economies of scale, a lot of that is passed through to them as a partner in the company. And that's when it becomes passive. Now, even if you're looking to passively invest in a deal like that, I'm telling you, it's still not passive, because you as an investor still need to do your due diligence up front. Now, you may choose not to, and that is unwise. And I want to counsel and encourage anyone to do that. So there is upfront due diligence, understanding the deal, understanding the operator, understanding the market. Different people have different comfort levels of how much they vet this, but even that is still not truly 100% passive.
You know, when I think of that, it's no different than if I were going to go and buy a single family or a STR or something. I'm going to have to do all that research and legwork on my own. And so It's doing that very similar initial research, that vetting of, well, why would I want to buy that house or duplex over that one? And why would I? So, I mean, either way, you're going to be doing your research and your due diligence. You're just applying that in a different way.
Absolutely.
Dallon, I knew we had to hit record right away because you and I, have great conversations all the time. I appreciate you so much. How can the conscious investor, what's the best way for them to connect up with you in addition to the Millionaire Mind podcast? Yeah,
so I'd say the 2 best ways to get in contact with us and just see what we're doing and what we're all about is, number one, our Instagram page, and that's at REV Multifamily. And we're trying to become more active on LinkedIn as well. I know there's a lot of professionals on there, so I just have a hard time. There's so many platforms out there. It's like, how do you pick and choose? So Instagram is the best one. We are on LinkedIn, so that could be another good place to connect, either REV Multifamily or Dallon Schultz. But I think to really get the most out of what we offer, check out our website, and that's investwithrev.com, because we put out a lot of free content, a lot of free resources out there. We have a 4 or 5 page document that we put together of how to vet an operator. And those are all the steps that we go through when we're vetting partners. So we just put it together and said, hey, here you go, investor. These are the questions we ask. You should be asking them too. And on there's also a link. We do weekly educational webinars all about apartment investing. And so that's been very effective because people are able to come on for free and just see who we are and better understand the process of getting involved into an investment like this. So there's additional resources like that on there. So Invest with Rev, REVMultifamilymeetup.com and Instagram and LinkedIn.
Thanks again, Dallon. I appreciate you so much. Conscious investor, you're amazing. Thank you so much for taking time to listen. And please, if you found this helpful, leave a rating and review that's honest, but share this with somebody else. Right now, the way the economy is and such, people are looking for resources that are going to help them make great financial choices for their future. So you can support them by sharing podcast episodes that are serving and supporting you in a powerful way. And so you're already doing your friends a favor. And remember, if you haven't already reached out, we're here to support you. So if you need support on the investing front, please make sure you schedule a time. There's a link in the show notes for you and I to connect, because I like to connect with people personally and individually. I know every single investor. I want to know what your goals are so that we can see, is it a right fit? Because remember, sometimes the investments aren't a right fit for every single person that I hop on a call with. And that's okay. I have lots of friends that I would trust with my capital that I can refer you out to that might have a better strategy for what you are aiming to accomplish. So don't hesitate to schedule time to talk. Until next time, live big, love bigger, and do great things. A lot of people missed out on my recent offering because they simply weren't on my investor list. Being on my newsletter list won't provide you with access to the deals I have. This is because 506B regulations require you and I actually discuss your investment goals before I can show you the deals I have. If you're on the fence about investing in apartments, schedule a call today at 3keysinvestments.com. If you think you're new, so you don't want to be on an investor list, you're missing out on opportunities to refine your ability to review offerings because you simply will never see them. So head over to 3 Keys Investments and schedule a call.